All right, this is the last chapter of the unit. And actually, you already have been dealing with this chapter. It is in regards to investment in financial markets. So, chapter 12. So, we're going to have a little banking in here, but we're going to talk a lot more about stocks. All right, an investment is basically a plunge into the unknown. We're going to look at that, evaluate the future. Basically, we're going to try to make profits, understand investment decisions, and how financial intermediaries facilitate investment, that loaning situation, the borrowing situation. All right. So, why investment spending is typically a volatile component? It's because making an investment involves cost today with the hope of gaining in the future. Can we fortune tell? Not financially, but the future itself can be uncertain. People are more or less optimistic, but sometimes they're pessimistic about the future. So those ups and downs happen in a result of investment spending. John Maynard Keynes, according to him, states that we're animal spirits. We go after something viciously. But it is also the reason that investment comes and goes. If you notice that you're making lots of money today and at the end of the day you kind of lost a lot of money, it's because people see, oh, got a lot of gains. You're selling at a high price and you're hoping to buy at a low price. All right, so if we look at investment spending as a share of GDP, it doesn't relate. It's a small portion, but it can mirror the GDP or the economy. If we look at accelerator theory, postulates or makes the supposition that investment decisions are more rational than actual Keynes animal spirit. We can predict them. The theory of investment says that current investment spending depends positively on future growth gains expected. All right. If we know things are good, probably in the next year, we know things are going to be good. If we listen to the news and everything is great about something, we want to get in now while the getting's good. Because if it starts to turn, that's when we start to get out of it. And in 1970 to 2017, you can see that for every recession that we had, the stock market took a hit. Investment is pro-cyclical. It follows in the same direction that the economy goes. It mirrors that action. It could mirror it, but it also could have a drastic. If we look at 1929, the economy was not doing so well. And everybody pulled out of the stock market. It crashed. Now, the economy itself didn't crash, but that stock market crash made it even follow the same thing. It made it even worse in the economy itself. So it's like dominoes. One thing happened here affects this thing. Ripple effects. Changes in investment can also have a multiplied effect. A decrease in investment can decreases the GDP, which then decreases the investment even more. If we look at energy prices, uncertainty reduces investment spending. If we think that gas prices are going to go up, when is the time to buy gas? Hopefully you said right now. But if we know that there's an overproduction of oil in the Middle East, we can expect gas prices to eventually fall. It's that supply and demand situation. Volatility of oil prices can hurt an economy, though, by creating uncertainty for firms making those business decisions. Can people get to work? Can people not get to work? Are people going to move closer to work? Imagine a firm considering investing in energy-saving technology. They're going to get away from oil. The returns from the investment then depend on future energy prices. If solar wind is where it's at, oil prices are going to go down. So investment may be delayed until that uncertainty itself resolves and a loss of that loss hits. So we know exactly where it hits. Now, we're talking future, but what happens to the present value? Suppose a good friend comes to you and says, I need some money. I need it really bad. Can you give me $100? I'll pay you 105 next year. Well, that's a 5% interest on your $100. Do you have a deal? Is it a good deal for you? Is $5 a lot of money, or is it a little bit? It depends on which is more valuable. If $105 from a year from now is typically less than your $100, then you've lost money. That dollar value changes. What happened in the 80s, if I'm making $56,000 in the 80s, am I making more or less than I am right now at $56,000? I'm hoping you say I would have made more in the 80s than I am right now because the dollar value changed. One way to think about the dollar value is what is the value today. It's the maximum amount a person is willing to pay today to receive a payment in the future. So if interest rates are high, is my dollar value as good or bad? If your friend is offering you 5%, you're going to receive lower interest rate than 5% on your savings. 105, meaning in your savings, you're taking that $100 out of your savings, you're giving it to your friend. All right, 105 1 year from now is worth more than 100 today. So more generally, if the interest rate I, the present value of an amount money K in 10 years is the equation present value equals K divided by 1 plus I to the time, the 10. If you could earn 10% interest instead, the present value of 105 next year is less than what 105 is. So if you take 100 divided by 1 plus 0.1 to the 1 year from now. So 1 year from now. So that's 100 divided by 1.1. You're only going to get 95.45 back. In value. Keep in mind, it's only what it's worth. So are you going to need to charge more interest rate at this point in time? It's going to matter more to you when you take out your first loan. So keep this in mind. This is really important when you go to borrow money for buying those cars that you're fixing to buy or that house. If we take the present value, the equation, the amount of money in the future increases. The interest rate decreases. The time you have to wait to get your money decreases. These are all factors that are going to affect present value. It decreases if the opposite is not going to, if present value decreases, all right? A complicating factor in understanding interest rates is knowing the difference between real versus nominal. Now, nominal interest rate is the real value plus inflation, whereas the real interest rate is what it is. Think about it this way. If you're quoted on your stock market game an interest rate to be returned to you, and the interest rate is different than what you get in the future, then you were quoted a nominal interest rate because the difference between the two is inflation or deflation, depending on the direction of that value? Is it a positive inflation, it grew, or is it a deflation, you lost money? All right, so nominal interest rate is minus the inflation rate. Generally, anytime we talk about it, whether it's real GDP versus nominal GDP, real interest rates versus nominal interest, inflation impacts everything we do. So if you're a debtor, you want inflation because when you pay back that loan, you pay it back quicker. If you're a loaner, somebody who loans out the money, you don't like inflation to happen after you've loaned the money. You want it to happen before you loan the money. Suppose the nominal rate of interest is 6% and the inflation rate is 4%. If you deposit $100, you receive $106 next year. But $100 worth of goods now costs you $104 instead. So you've lost $4. You can now typically only purchase 2 additional goods and services because you've gotten interest and you had to pay inflation. The difference between 6% interest minus 4% interest is how much you actually are allowed an additional amount. If we have expected real interest rates, firms and individuals borrow and lend based off of what they know. They do not know typically what the rate of inflation is going to be. We've been predicting that we're going to have a bust anytime because as soon as that inflation hits, things are going to crash. All right? But for the last, let's say, 7 years, inflation's only been 2.5%. We've had a boom. It didn't hurt us. However, we've been predicting for those 7 years that we were going to bust as soon as inflation hit. We are seeing that evidence now. We don't have a magnifying glass to the future, so we have to guesstimate what that inflation is going to be. So forming expectations or estimating what that rate is why we estimate when a crash is going to happen in the economy or when a boom might happen. So the nominal interest rate minus expected inflation helps us determine some of that expected real interest rate. We determine that by expecting real interest rates, we need to know what people expect inflation to be. If we expect inflation to jump up 6 more points, if it had happened when we predicted it, we would have had a recession before COVID. For this, we typically have to rely on forecasting. What do we already know as red flags? Okay, so prices are going up. That's a red flag. Is it inflation though? Well, did wages go up? Or did interest rates go up? Or did interest rates come down? Lots of different things. But if we're looking at just the interest rates, if we can expect interest rates to increase anytime soon, we can somewhat form an educated opinion, a hypothesis of when that's going to happen. All right, interest rates on corporate typically get created though. So I'm going to start talking to you a little bit about what's going to be important to you. Think about credit cards. You're going to go into, you're 18, 19, you're going to go into college and you're going to get offered credit cards. Pay attention. Credit scores affect the percentage interest applied to what you are given on those credit cards. All right? If you have a low credit score, you're going to have a high rate of interest rates. If you have a high level score on your credit, you're going to have a low interest rate. If we look at corporations and their abilities to consistently pay every time they borrow money, they typically would have a high credit score, right? We label them as AAA. if you have a single A, you're not necessarily got the best credit score in paying back a loan. If you have a triple A, we're rating you at having pretty good credit as far as a corporation goes. So if you take your credit score and compare it to a corporation's credit score, you're looking at anything that is between 6 and 7 is good. Anything 7 and above is excellent. Anything below 6, you're iffy. All right, so on a corporation, 2 is about average, 1 is not so good, and 3 is excellent on A levels, like triple A. All right, and if you look at this graph, this is kind of how it looks to a loaner. If you're volatile, but you're consistently volatile, you probably have a rather good time. The length of time is also going to play a factor. How fast are you going to pay it back? You have a 10-year loan, you pay it back in 5. Man, I'm going to loan you more money because I'm getting my money back. However, if you have a 10-year loan and you pay irregular payments, like, oh, I'm going to make $100 here, I'm not going to pay next month, I'm going to make $200 the third month, I'm going to not pay the fourth month, and years wise, and on the 5th year, I'm going to just dump it all. That's going to also affect how a loaner looks at you, because you're not consistent in your payments, and they like consistency. So while we often talk as if there's only one interest rate, we all technically get rated and get multiple different interest rates. Riskier loans and loans for longer maturities typically have high interest rates, all right? Low scored credit is going to have a high. Short term is going to have a low. All right, so let's look at the last recession. It ended in 2009. U.S. investment was even lower than normal. People weren't building. Despite reasonable high firm profits and a recovering stock market, people were scared. Some investment is not actually counted. Investment into technology, software, new management practices, we don't care about that. Decreased competition reduced the need to actually invest. When people go out of business, well, that means I'm doing pretty darn good. All right, shareholders want firms to avoid risk. When people get scared, they say, that person doesn't need any money. They don't pay any money back. You know, those kinds of ideas can affect why we lower interest rates. So what lowering interest rates, if the government lowered the federal interest rates, that's telling the banks, hey, you need to loan out some money because we're stalling here. The economy's fixing to bust if you don't fix it. And so the banks are encouraged at that point. They're got the confidence, hey, the government's got my back. Let's go ahead and loan out some money. And unfortunately, that got us into major trouble. All right? That's what led to 2009. All right, if we understand investment decisions, we can technically use the tools of present value and interest rates to actually understand how to invest. If I know that I'm going to get more money in the future and the rate of interest is high in the future, I'm going to want to get into that company. So one simple investment rule is invest in a project if the cost you incur today is less than or equal to present value of future payments. This is exactly what we mean by buy low, sell high. This is where it comes from. Suppose a firm has 5 potential projects, A to E. It can complete any or all of them, incurring the cost today and receive the return next year. The lower the interest rates, the more of investment can become profitable. So if we look at the return, E is our best investment. C is our average, while A, come and go. Many firms simultaneously make these decisions on a second-by-second basis. At lower interest rates, more investments are made, and total investment spending is higher. Other factors also include how profits will be taxed. If you're going to get taxed higher, you're not going to be making as much money after these investment decisions are done. All right. If we look at a classical, or in our case, a neoclassical, the new classic theory of investment, a theory of investment that says both real interest rates and taxes are important. You're not going to want to put your money in with high interest rates and high tax at the end, because you won't make any money. Basically, you're just going to balance out. You want low tax, high interest rates, and it to cost you little today. So when the level of the stock market is high, investment spending tends to be high. Firms can finance investment through retaining earnings, selling corporate bonds, or issuing new shares. Now, a new share is going to split the price of the stock. Each of these is easier when people are confident about the value of firms, resulting in high stock prices. Retained earnings, these are corporate earnings that are not paid out as dividends. They're reinvested into the business. Corporate bonds are bonds that are sold by corporate to the public. It's basically saying, hey, public, I need some money. I need lots and lots and lots of money, and here's the interest rate. I'll pay you back when I'm ready to cash out. Usually you have to vet, and you have to hold that stock for a period of time. Sometimes it could be 5 years, 10 years, 15 years, whatever the bond is actually stating. All right, expectations play a major role. Price of stock equals the present value of expected future dividend payments. You've seen these graphs if you've looked at some of those company stocks. As optimism about the economy fades, so do stock prices. They mirror the economy and hence investment spending. The last couple of decades seem to confirm the high stock. Unfortunately, the last few years didn't. So keep this in mind. Prices typically in the past led to high investment. This idea is formalized in our Q theory, which is investment that links investment spending to stock prices. Now it's on a day-to-day basis, not on a decade basis. And this is what got banks into trouble. They thought, I can make my money back today if the stock market holds. Unfortunately, they were using loans and they were selling it on the market, and they were calling these derivatives. So during the housing boom of the mid-early 2000s, many people borrowed to purchase their homes. And when prices fell, people were below or underwater on their homes. And if they needed to borrow money, well, if you're already below, that would put you even further in debt, right? So such households typically cut their spending significantly, prolonging the effects of the recession that happened. Would helping people out with loan assistance have helped, or would it have hurt? I'm going to say it probably would have hurt, in my opinion. You may think differently, and there's where the controversy is. You and I may not necessarily agree, and this is what happened in Congress. All right? People had a hard time letting homeowners be debt forgiven, especially when it didn't impact their credit score. All right. I'm going to list some ways the financial intermediation can facilitate investments, though. They are basically intermediaries or organizations that receive funds from savers, and they challenge them to investors. Sound like a bank? Very similar to. We might have banks. We might have savings and loan. We have insurance companies. We might have mutual fund operators. All right, so we might have people like Chase, Bank of America, Wells Fargo, all on our bank side and savings and loans. Then the insurance company would be AIG. A mutual funds operator would be like Merrill Lynch and Citigroup. All right, there are all different kinds of labels we can put out there. There were financial intermediaries, people who have the money. They make the moves. How can these organizations help investment to take place? One is they facilitate, they have the money. One important recent change in a financial is securitization. That's the practice of purchasing loans, repackaging them up, and selling them. This is their incentive to give you a loan, even if it's a bad loan. If you see those people that are like, oh, bad credit, good credit, no credit, we're good, we'll loan you money. What they're saying is, as to the bank, is, okay, I'm going to give you some of these oddball loans. You're going to repackage them and resell them so I can make my money. You're going to resell them on the market. All right, traditionally, a small bank making a home loan is going to receive the stream of payments from a loan over time. You got that nice relationship with people, and they're going to pay you back regardless. Large government-sponsored financial intermediaries like Fannie Mae and Freddie Mac allow banks to sell those loans, giving them funds to make more loans. This securitization spread to other debt like credit cards and consumer. You know, when you need money, you're going to borrow money. You're going to take out a payday loan. You're going to pay that loan. And all this interest rate, the interest is going to kill you when you have to pay it back. And that's what caused a lot of this, is the interest payments. Because when you pay interest, you're not paying on the amount you owe. You're only paying the interest. All right, suppose the firms, though, had obtained funds directly from savers. Those savers' liquidity, they don't like the risk. They would have also incurred substantial costs evaluating which firms then make wise decisions. Oh, you're a risky company. I'm not going to go with you and put my money there. No, because you'll close the doors as soon as the banks run. All right, so savers typically would require high interest rates to lend directly to firms. This is a liquidity, the ability to convert loans to cash or savings to cash on short notice. The faster I can move that money, the higher the liquidity. The slower it takes for me to move that money, the lower the liquidity, or the higher the liquidity, means that I can tip. It takes me a long time. Sorry, I reversed it. Higher liquidity, long time. Lower liquidity, fast time. All right. Financial intermediaries make these transactions, though, easier. You put it in the bank, they deal with all the time changes. Increasing liquidity. Not all savers tend to demand their money right now. So more of it can technically be tied up long term, because you put your money in the bank, and unless you're living hand to mouth, you're not going to need that money right away. You save. Also, banks' diversification has a tendency to lots of lending lots of investors, and their return pay is going to be different per person. So if that insuring many individuals and firms, their risk is typically less. Like if Johnny borrows and pays back really quick, but Mary over here borrows and she's a slow payer, and we got an average payer in the middle somewhere, they balance out. And that's all that's necessarily to keep things stable. Securitization, though, created new financial instruments for investors to buy and sell. Many financial intermediaries seeking high profits became highly leveraged. With this, the increased leverage came at an increase in risk, and financial intermediaries were obliged to pay off their debts regardless of actual performance of the assets they purchased. So if you had a bad player and you owed money, the money's not coming in, but you still got to pay. So, having that asset owe you money kind of hurts you if you have lots of them. All right, leverage is just another word of saying borrowing funds to purchase assets. So I'm technically borrowing to pay Peter Y'all have heard that before? All right. In the early days of the Great Depression, many small banks loans began to fail. Oh, people got into hardships. Depositors would often then panic, withdrawing their funds. Unfortunately, a small bank only has a small amount of money. This often led to banks themselves failing and needing to borrow money and going to banks to borrow. And well, if those other banks started doing things, panic happens. And this leads into the stock market because panicky people become panicky investors, simultaneously withdrawing their funds from the bank. They withdraw them from the stock market, domino affecting. And in 1933, the U.S. government began to provide some security here. They began to deposit insurance plan. The FDIC began in 1933 to reimburse up to $250,000 those who deposited their money into the banks. You've heard this from U.S. history, I hope. All right, so deposit insurance is just basically government backed. Hey, I got you. Go ahead. Your money's good in this bank. Leave it here. Don't pull it out. Everything's confident. All right. The savings and loan crisis institution were made low interest fixed rate mortgage loans to households in the 1970s. This is what happened when interest rates then rose in the late 1970s and early 1980s. Savings and loans then began to fail. Deregulation of the industry allowed savings and loans to try to recoup where they could with risky investments on the stock market, but many of those had a tendency to fail. Households continue to save with savings and loan despite this because that idea that they're protected. Taxpayers ended up paying nearly $100 billion to bail out failed savings and loans in the 80s. Many mortgages in 2007 started to fail in 2000. 9/11 happened. And then late 2000s, this was due to the fact that you couldn't flip your houses. Falling housing prices led to falling equity in homes. This caused major disruption in the market for securitization loans, in turn disrupting credit in other sectors like GE couldn't borrow money and people were not buying things and people were getting scared and not taking home loans out. Runs occurred on financial institutes like Bear Stearns. They started pulling out. Hey, I don't want my deposits, dude. Something's happening. Again, that bank run happened. Lehman Brothers was last. But from those two, we also had both of those close as a result of it. We had others like Merrill Lynch and Wachovia Bank were forced to sell to other financial institutions. So if you think about it, ever go into Bank of America and notice that Merrill Lynch is their stockbrokers? That's because the two of them merged in 2008 because they were forced to merge by the government. But this led to typically plunging stock prices and difficulty in obtaining credit for businesses and governments. McDonald's couldn't pay its employees. GE couldn't take care of its business on a day-to-day business. A lot of these things weren't just bank related. All right. Government's response, and this is important to understand. Central banks, including the Fed, made loans and credit easier to obtain for financial institutions. We fixed it so that banks would not fail. The U.S. Congress passed what is known as the TARP, or Troubled Assets Relief Program, which allowed it to provide emergency funding to many large financial institutions who employed thousands upon thousands of people, and we did not need them unemployed. Later, U.S. Congress enacted the Dodd-Frank legislation to try to limit future over-leverage by financial institutions. We're telling the banks, stop playing with our money. Unfortunately, some people got rid of Dodd-Frank or limited the action Dodd-Frank could happen. So we don't have as much regulations on banks as we did. All right, but Dodd-Frank created a committee of regulators to oversee large financial firms and make them ensure their financial health. They forced large financial firms to develop living wills or plans for what to do in future times of financial distress. What are you gonna do to fix this instead of making us fix it? They restricted the investment large banks could make in order to lower risk taking, and I think that is the part they have reduced. They also created the Consumer Financial Protection Bureau, which some believe operates a little bit too independently. And so I think that's another one of those that kind of got reduced. And that is chapter 12. Hopefully this will help you with the stock market. Those of you who are not playing, I can see this. I can see your portfolio. You need to get up off the couch and start investing. Your paper that I'm fixing to talk about by the end of this week is going to rely on your experience. So this is chapter 12. Chapter 13 to 16 will not have a test. Chapter 12, hopefully this will be the last you have to view and should help you take your test, which is due by Friday.